Today I'm talking about the 5 worst investment decisions I made in my journey and sharing what I took away from them. Now, I hope that this prevents others from making the same errors. I'm Vinny, and I reached financial independence at 45 and retired from my career in technology so I could play competitive sports, travel the world, spend more time with my family, and gain new experiences. Now, people often say you either win or you learn. Very true, when the stakes are not that high. Now, big investment mistakes in your journey can derail your timelines for financial independence. Now, even if they cost you a couple years, that is like 2 years lost of maximizing value of your health, wealth, and time. So sure, it's great to learn from your mistakes, but even better if you can learn from the mistakes made by others. Now, these mistakes I made are in no particular order, so I'll get right to it. Mistake number 1, buying call options. This nearly caused me to go bankrupt back in 2008. Buying call options or even put options can be very lucrative if your prediction comes true. Now, when you buy call options, you are betting that the underlying stock is going to go up considerably in the short term. And when you buy put options, you are betting that the stock is going to go down significantly before your option expires. Now, if your prediction comes true, then you can make multiples of your investment in the very short term. Now, I learned the basics of options trading back in 2008, thought I'd give it a try. So I went to my brokerage account in Fidelity. You answer a few questions, and it allows you to upgrade your account for allowing options trading. And then I was off to the races. And I hit the jackpot. We call it beginner's luck in the very first call option I bought. So I bought $500 worth of out of the money call options for LinkedIn. And a few days later, Microsoft announced that they were acquiring the company, and the stock shot through the roof. I sold my options for about $7,000, and I felt that I had discovered the formula of making insane money in the stock market. And then used all the funds I had in my brokerage account at the time to buy options of various companies that I thought will do really well because I had my hypothesis. So it wasn't just blindly picking stocks. But when the entire market tanks, like it did in 2008, all your hypothesis is gone out the window. And I lost everything. Luckily, I only had about $25,000 in my account. If I had more, I probably would have lost more. When we have less to invest, the thought of investing in broad market funds feels like a long journey to make any significant amount of money. So we try to take the shortcut. Making the first $100,000 is often the longest journey, and it requires patience. So even though I knew about long-term market risks and the power of compounding, I tried to justify my actions internally thinking, well, if I turn this 25K into 100K quickly, and then it'll be large enough for me to invest in index funds where the 10 to 12% returns would be meaningful. Now, instead of buying call options, I sell covered calls. That is, using the stocks I already own to sell out of the money call options that expire in the next week or 2 weeks. This way, I scratch my options itch and make about like $300 a week. It's like being house in a casino. There are a few times that the gamblers you are selling options to will win, but on most occasions, you will win. So if you consider doing this, it's better to do it in your tax-free or your tax-deferred accounts so you don't have to deal with the short-term capital gains or even the gains out of selling your stocks. So you avoid all of that if you do it in your tax-free or tax-deferred accounts like your Roth. or your IRA or your 401k accounts. Mistake number two, foreign real estate. So I bought an apartment in Mumbai, India as an investment. I'm originally from Mumbai. My parents still live there. I figured it was a safe investment as real estate continued to, go up there. And it was rumored that a new airport was going to be built in that region and that the plans were already approved by the government. So I chose a well reputed builder to invest and ended up paying about $100,000 in a 2-year period. So you keep paying installments as the property is being constructed. Now, this was 4 million rupees in Indian currency at the time. So, after 10 years of waiting for the new airport, I finally sold the apartment for 9 million rupees. 125% returns in 10 years. Not too bad, right? Why is that a mistake? Well, after paying closing costs and realtor fees, I got back 8.5 million rupees. Still, 112.5% gains. Not too bad. Not amazing, but not too bad. Until you realize how much you got back. When I bought the apartment, $1 was 40 Indian rupees. And then when I sold, $1 was 85 Indian rupees. So when I got the money back to the US, I received $100,000. Exactly the same I put in 10 years ago. So for 10 years, I might as well have kept that money in my checking account or under my mattress. Now, some of you may hear this and say, well, at least you didn't lose any money. And if you say that, then there's one concept you really need to understand, and that is opportunity cost and the time value of money. Now, just with inflation, I would need about $130,000 to have the same purchasing power of $100,000 10 years ago. And what if I had just put that $100,000 in a US total market fund like VTI? It looks like in 10 years, $100,000 in VTI would have grown to $333,400. When you invest in anything, you want to judge your performance and compare the results against the alternative safe investments you could have made. This was a $233,400 mistake. What I have learned is if you want exposure to a certain country because you're bullish about it, then just buy the ETFs that have large exposure to that particular country. I am bullish about India. I am bullish about Japan now. I own an ETF called INDA for India exposure and an ETF called DXJ for Japan because I'm bullish about these countries for the next few years at least. And these have done pretty well. I would not invest in physical foreign assets in these countries, especially based on some speculation of huge government projects or other projects. A lot of these rumors never pan out or get delayed. And then you lose out on the opportunity costs. And then, of course, the financial transaction costs, foreign exchange costs. And I'm not even going to discuss the nightmarish process it took for us to sell that property. Keep it simple. If you want to invest in a particular country, find an ETF that has exposure there and simply buy it from your brokerage account. You have access to all kinds of investments in all brokerage accounts sitting in the United States. Now, mistake number 3. buying stocks promoted by YouTube influencers or other influencers. Now, YouTube is amazing when you want to learn something or you want to hear about other people's journeys for inspiration, for learning, education. Just not a great place to get stock advice. I learned this the hard way. I think it was late 2020 or early 2021 when, after COVID, when the market tanked and then it went back up, the stock market was on a tear. And we had the GameStop saga. We had so many different types of cryptocurrencies. We had something called SPACs, which were companies that were being traded without having to go through the IPO process. And people were making tons of money since all of these were going up in multiples. People couldn't spend money, so they had this extra money and they were investing. That gave rise to so many YouTubers talking about their rationale on why you should buy a certain crypto or a SPAC or a penny stock. Now, these YouTubers had thousands of subscribers. I guess people had a lot of time sitting at home watching YouTube during COVID. But I fell into the trap, either because I felt that these people have so many subscribers, so others must know something that I don't, or they told a really great story and made me feel stupid if I didn't get in on the action. Now, during this time, I must have invested about $50,000 into these speculative trades and lost about $40,000 before I got out. I'm never buying small stocks based on YouTube influencers again. I've learned my lesson. You will have a few winners, but they will not compensate for the number of losers. And you'll have to time when you sell this perfectly, because these go up and they go down really fast in one day. So now one might say, hey, I invest 90% of my portfolio in the total stock market or the S&P 500. And the rest of the 10% I use to invest in speculative stocks that can add some oomph to my returns. Sure, they can add oomph, but more likely they will reduce your returns such that the safe withdrawal rate for you doesn't work anymore. Like, let's go through an example, right? Say you have $100,000. You invest 90,000 in VTI, the total US stock market ETF. And then the rest of the 10,000 in altcoins, speculative moonshots, and say VTI gives you the historical average of 11%. And your speculative investments net out to a 60% loss. Now I'm saying 60%, I had an 80% loss, but let's say 60%. So now, at the end of the year, you have 103,000 from your 100,000 because the 90% gave you, yielding 11%, gave you 9,000, but the other 10,000 resulted in a loss, leaving you with just 4,000. So you have 103. So yes, instead of 11% gain, you now have only a 3% gain. It could have been 111,000, you now have 103. Yes, even VTI can have bad years, but you can wait it out because historically it has always bounced back over the last 120 years and given you 11% return over time. However, these penny stocks or SPACs just get delisted and they're gone forever. You cannot recover. All right. Mistake number 4, investing into someone else's small business. In 2019, a couple of my friends and I went to a CBD store. If you don't know what a CBD store is, it's this cannabis-based products. There were some approvals, and then that became legit. And these products help in several ailments, It's not just to get high, um, and it has lots of medicinal value. And they were taking off. And we had gone to the store primarily to buy products that could help ease the pain of a friend of ours who was fighting cancer. Now the store was quite busy, and we were last in line, and so when we got finally up there to the owner, there was nobody else, and we got talking to him about his business, and he sold us on how great the business was, and he was looking for investors to open a new store at another suburb. Now, we met him a few times after that, and before you knew it, we had put $50,000 together into this new store idea as sleeping partners. Long story short, we didn't see any returns. The book seemed cooked. We finally, after months, had to take him to court. We won the lawsuit, but there was so much loss of time, our energy, and we only recouped part of the investment because you have lawyer fees and all of that. That's when I decided never to invest in equity in someone else's small business. Whether I know the person well or not, or whether it's a stranger. It's just too tedious for you to go over their accounting. You have to trust, and if it's with a friend, then it's even worse because even if the business is going really well, you really don't understand those books. And if it's going through a loss, despite your friend's best efforts, you are going to wonder. And that's worse for your friendship. I do invest with friends though, but it's always as a fixed interest promissory note. And even though there is collateral usually associated against the note, my understanding is that the friendship is strong enough and the money loaned is small enough that my friend would find a way to make me whole again if things got really bad. Now, these notes typically range from 10 to 14% interest, and they've worked out for me pretty well and for my friends. It also doesn't complicate the friendship, and it gives you immense satisfaction when your friend sells his business or her business for multiple millions, and you know that you were, in a small way, part of that success. Mistake number 5. Now, this is not really an investment mistake, but it is more of a mistake you do with your asset allocation. That is overweighting your own company stock in your portfolio. Now, sometimes because we know more about our own company than others, we hear the company rhetoric, the CEO speeches, etc., and we end up being more bullish about our own company stock. In other cases, like in my case, maybe you get annual equity and you let it sit after vesting. Now, the problem with this is twofold. You are investing in the same place where you are getting compensation from. So, if that company has a problem, then not only can your portfolio crash, but you also may not have a job. And then, secondly, if your portfolio is heavily tilted towards your own company, then your own financial independence timeline is heavily dictated by your company stock performance. That's one stock amongst 6,000 plus stocks in the US stock market. Now, I ran into this issue with about 50% of my portfolio being in my company stock. Looking at my portfolio, I thought I had reached FI towards the end of 2021 when my company stock had peaked. And then it was such a setback when the stock price crashed nearly 50% in the next 6 months. My overall portfolio had gone down by 25% in 6 months just on my company stock side. During the same time, the market had gone down 20%. So overall, I had lost 35% of my portfolio. Now, in 2 years, the market bounced back as it always does and has now gained an additional 20 to 25%. But my company stock never recovered to that point. Maybe it will, maybe it won't. The point here is that an individual company is usually much more volatile than the entire stock market. And sometimes it may never recover completely from a crash, whereas the market always does. So, if in your financial independence journey you are relying on the market value of your own company stock as a significant part of your portfolio, your FI journey could become incredibly volatile. Now, would I have retired when my FI number I'd reached initially, when my company stock had peaked? I don't know. But I do know that it was extremely disheartening to know that I had reached my number and 6 months later to understand that I had still had ways to go. Now, my recommendation would be to determine a percentage of your portfolio that you will not go over with your company stock and keep selling your vested equity to get back to that percentage. Whether that percentage is 10% or 25%, that's your choice. But don't let it go to like 50% like I did. So, anyway, those were my 5 biggest investing mistakes and lessons I learned from them. I've made other mistakes in addition to these, but I would love to hear from you. Are there mistakes you have made? What did you learn from them? Also, if you like this content, then please let me know what other topics you'd like for me to get to in the future. And do like and subscribe and savor the journey.